sometimes the tail starts wagging the dog. If I had figured out that gold mining companies in the next decade would have used shareholders' money to buy that gold back, we wouldn't be having this conversation. I'd be in the south of France. You would never have convinced me in 2001 that Newcrest would go to the market and raise $2 billion, buy $5 billion worth of gold in a week and a half to crystallise a $2 billion loss and use shareholders' money to pay that loss. The minute that you say, please, sir, can I roll that hedging forward when it's out of the money, you've got to treat it like debt. It's like a gold-denominated debt. Regis's strategy was very simple, and every time they had a higher price spot, they would sell spot and they would roll their hedges forward. And they were very open about that. But the problem with doing that was as that loss got bigger, the unrealised loss, although it was unrealised, it wasn't uncharged. They were essentially earning no contango. I will be absolutely happy to say to you that Sons of Gwalia, their strategy in their last days, like trying to acquire ounces, some of the deals they did, I have absolutely no doubt they did that to increase their production profile, to try and diminish their hedge obligation.
Money Miners, welcome to the show. Thursday, 21st of September, boys. Now today's episode.
A special interview in store, don't we?
Talk about someone that knows a fuckload about something. Is that, without giving too much away, that is how I would describe this fella.
There's some real niche parts of this mining finance world, Matty, and when someone spends their entire career on a very, very niche part of it, you can feel the passion when they talk about it, and they can explain it in ways that often are pretty relatable. This guy fits that bill. He kind of is across a very niche part of the mining finance world more than anyone I've ever met, and I learnt a fair few things in the conversation we had with him.
And they probably enjoy, when you know something niche, and then you find someone that's willing to listen to you. That's when you get them going.
Even more than that, mate. We weren't just willing to listen; we're willing to share the story. So this is Sean Russo. Sean Russo runs Noah's Rule. I don't want to tell the money miners what Noah's Rule does just yet, because you probably actually had a sneak peek in the preview we played before. But this guy's fascinating. It's a super specific part of the market, but like we're all the wiser for really getting in the weeds of this specific part of the market, and he is the expert in it. What did you think of the chat, JD?
Yeah, I mean, like many of the people we speak to, Trav, is another guy is just a wealth of knowledge, There's heaps, and you can learn so much. He's been in the industry since the 80s. He's engaging, had plenty of great stories, about some, fallen giants of the mining industry. So I learnt plenty from him, and I reckon, without getting into what it is, mate,
yeah,
we can sort of...
You're trying to suck viewers in to get the average listener duration up or something? Is this a strategy thing by you too?
It's a strategy because it's like if you say the word that the topic's about, I reckon people would be disinterested. I'm trying to hook as much as possible because it's worth listening to.
Yes.
That's it. Before we get into it,
there's always a strategy. Right. Partners for today, JP Search, the absolute GCs of the recruitment industry, specifically and we talk about niches. These guys, the finance world, integrated within mining and finance, CFOs and all that. Trav, have they got any fucking jobs going at the moment? Like, look, if the podcast shits itself and I'm looking to hedge my bets, you'd say.
Yeah. So they're not really CFOs. That's not quite their niche is sort of like the guys like JD and I that work at places for, corporate development teams, investment banks. Because
they're not impartial to a CFO because they
effing,
CFO, because that's I said CFO because they good coin in a CFO.
You want to clip another ticket? Well, last time I spoke about them, I was alluding to the fact that they got these like wicked mandates with firms. And they actually sent me a page with some of the places that they do work with frequently, and they include places like Tatarang, Liontown, Barrenjoey, FFI, Azua, Rio Tinto, South 32, CFC, Minderoo. Like there's a bunch of Hesperia. So the family offices, these are ones who are public, but they've also always got a bunch of mandates that you never really know about until you pick up the phone and talk with them, because a lot of the really, really cool stuff is private.
Very good. If you're in the finance world looking, or you might not be looking, give JP Search a call, or maybe they'll call you. Is that their business logo?
I don't know.
Maybe we'll call you. I like it. Righto, let's get into the Noah's Rule chat about the unidentified topic. Let's rip it.
G'day, Money Miners. Today we're going to talk about a really important feature of a lot of companies that we discuss on our podcast. It's a feature that keeps companies alive when times are tough and makes them look absolutely stupid when times are good. It's also a feature of mining companies that has a lot of misconceptions out there about it, JD. And if I told you what this feature was right now, I think some of our listeners might actually switch off and they'll just think it's boring. So I'm not going to mention the word or what it's about just yet. But safe to say, I think there are some really important things to understand about this topic, and we'll collectively be all the wiser and hopefully better investors after learning about it. So the guest that we have with us to discuss this topic is Sean Russo. Welcome to the show, Sean.
Thanks very much, Travis. Good to be here. I really enjoy. I'm a big fan of the show, so I'm delighted to be on.
Sean, you've got a pretty fascinating background. You did 20 odd years at Rothschild, and when we met you face to face, you came in the office last week, and you'd read a large number of the books on the bookshelf that we've got. You even mentioned that you called out in the Trevor Sykes book. It's a favourite of all of ours. So for the last 20 or so years, you've been running Noah's Rule, and I think we've done what we can to hook the money miners on why they really should listen to this. But I want to hear it from yourself now. Why is the topic that we're going to talk about, sexy and something that the money miners need to know about?
Well, I'm going to start by giving you a list of people who've been very successful in the industry. And I think any junior miner says, I want to be the next Bill, I want to be the next Jake, I want to be the next Mark Clark, I want to be the next Raleigh Finlayson. Every single one of those guys, hedging has been part of their success. In the early days of their businesses, to avoid dilution, to keep their capital structures tight, to use debt, hedging's been some part of that. So I always find it interesting when we have this discussion, we go, oh, mate, not hedging, we don't do that. Shareholders want upside. Some of the greatest success stories in the industry, you look at the people that have done it, you look at the people want to emulate, they all did it.
So what are the biggest misconceptions that you see out there with regard to hedging then, Sean?
For both the punters and the gold miners.
Yeah, sure. Well, one of them is that, by hedging, you give up the upside. And the idea that you give away revenue is one thing, but what about earnings per share? So, again, hedging, if you go to the end of a project or you look at them, we'll talk some of them today, I'm sure. And with the glorious hindsight, you can see whether the people did a good job or a bad job. The cost of hedging, if you start to talk about how much money they might have made if they didn't hedge, has to be measured against the value of dilution avoided. You look at the value of the increase in the company over that time by keeping the register tight when they're a 20-cent company makes a very big difference and helps them much more easily get to be a $5 company or a $6 company. Dilution is a far more toxic thing. Equity dilution is far more toxic than derivatives. And yet it's far more common, but no one talks about it. No one ever goes, oh, you shouldn't have done that raising back in whenever, right? So I think that's one big one. Another big one is a lot of mining companies say, oh, the banks just make you do hedging so they make more money. So I'm not going to do that. I was involved in a couple of mining finance transactions when I was at Rothschild in the late 90s. We lent companies order of $30 or $40 million, and when they went broke, they owed us $60 or $70 million because the hedging was out of the money, the mine had failed. So, banks don't always make money out of hedging. It's certainly part of their revenue stream, but it's not, that's not the reason they do it. They do hedging to keep the mines in business during the debt service period. That's really the big thing. So I think those are the two core ones. And then people like to throw out things like Sons of Gwalia and Pasminco and go, well, look, they went broke and they did hedging. So, that's the reason you can't do it. And I think particularly I'll say NEDs and people my age, so 60 and older, late 50s who were around in the late 90s, it's really easy. They've now developed into their career and they're now NEDs and they go, oh, yes, well, of course, Sons of Gwalia and Pasminco, two very good examples, but they're not. We could talk about that later as we discussed, but, those guys were using hedging products, but they weren't hedging. They were speculating with derivatives. Very, very big difference.
Yeah, let's get into that right now because it's such a fascinating story. There was the hedging, the derivatives, the short-term trading, everything going on at Sons of Gwalia, as you've touched on. And I think it's just an intriguing one, and we're going to try and do it through this conversation, is just weave in these real-world examples of, incidents where hedging, it's what comes to mind when the punters think about it. So,
yeah, absolutely.
In the case of Sons of Gwalia, if you just spoke to the typical bloke off the street who's been around markets for long enough, and you asked them what went wrong at Sons of Gwalia, they'll probably have a story that goes something like Sons of Gwalia blew up because they had a hedge book that was out of the money, and then there was a pit wall failure at Tarmoola, now known as King of the Hills, and that tipped them over the edge. Is that right?
I think the pit wall failure didn't help. The thing that triggered it, I spent 20 years at Rothschild. I only ever applied for one job in all that time, and I applied to be the managing director of Sons of Gwalia.
Really? Wow.
Yes.
So is this when got put into administration and you?
No, Mark Kudafani had just left.
Yeah.
And I called up Peter Layla, who I knew, because we're both on the board of a refining company. Our refining company had merged with the Perth Mint. He was on the board there, and thankfully, perhaps the headhunter rejected me because I didn't have any public company experience. I'd spent about 16 years working for a private company. But the reason I joined is I thought they know about mining, but they've got some real derivative problems. Maybe I can help them solve it. So even then, I think it was a well-known secret in the mining industry that Sons of Gwalia had some issues with their hedging. But, the pit wall failure besides, the new managing director, the guy that got the job I applied for, he actually, they did a reserve downgrade. And it was when they did the reserve downgrade that the banks all went, holy dooly, like that level of reserves, I've got more derivative exposure than that. There was a lot of different banks that had the product.
And that was one of the covenants that they turned out to be breaching for a long time, right? There was a ratio of hedging to reserve ounces, I believe.
Yeah, they, by virtue of the size, and remember too, that Sons of Gwalia, I want to say their share price was something like $2.20 when they went into administration. That's extraordinary. And, normally the share price declines, the market knows that the company's in trouble. There was very little in that. And also at the time, which is funny giving a look today, they were, tantalum was their big thing, right? They were talking about they were a high-tech company as well. And that was the whole thing. Lithium was waste back then. Tantalum was
green bushes.
Crazy. Wow.
Yeah.
What a behemoth they've been those still around. Yeah.
Yes, so they were talking about mobile phones and all that stuff and distracting from the gold. But coming back to the gold, at the very simple core of it, sometime in the mid-90s, gold prices were very low and they wanted to have higher prices. And somebody inside the company talked to an investment banker, a bulge bracket investment banker, and said, I need a higher price tomorrow. This is what I'd like to. How do you do that? And the product at the core of their failure was a thing called an index put option. And we did some work. We did substantial amount of work for years. In fact, the earliest job we had at Noah's Rule was helping the estate through the receiver manager of Sons of Gwalia do all the forensic work on this hedge book. So I knew most of what was going on before we did that job, and the rest we learned after. But there was a product called the index put option. And the interesting thing was we Googled index put option. And this is early days of Google, admittedly, around 2004, 2005. But we Googled index put option. The only references we could find in Google was to Sons of Gwalia's accounts and an oil company in Texas that had indexed options for their employee options were indexed to the oil price. So there was no other reference. So the auditors clearly, they can't have known what they were. What they were, in short, was for every ounce of cover that you got in the nearby, you committed to losing money on 6 ounces in the future. So you bought one put option and you sold 6 calls, but they weren't called call options. It was an indexing to the price. And it allowed the company, in their view, to say, we hold put options, we don't have committed hedging. And John McDonald, who'd be one of the best analysts going around in my
former colleague
career.
Of both of JD and ours.
All right, there you go. Well, great guy. You know what he's like. He was the person asking the questions going, how come the negative mark to market, which Sons of Gwalia did report to the market, how come it's going up? If they only own put options. Like if they own put options, the value of the put options should be falling if the price goes up, but they shouldn't have a negative mark to market. And their negative mark to market was going up because the banks were sending them mark to market statements, which did have these embedded derivatives in. It's a little bit complicated. But in short, it was like, give me a higher price tomorrow that solves my nearby problem, and 5 years out, I'll give you 5 times the gold price increase above that level. Now, I should say, I don't think when the company entered into those contracts that they understood what they did. I don't think they understood it, because the formula had lots of moving parts in this product, and it was quite complicated in the way it was presented. It was very simple in its essence once you understood what it was. But it solved a short-term problem. And I guess back then people used to say things like, if the gold price goes up, that's fine because we'll produce a lot more gold and we'll be able to deal with it. But they weren't the only people that did it, but they were the only people that really got caught out in the end.
Solved a short-term problem for them, but created a long-term problem for you, having to rebut the critique that comes up about Sons of Gwalia's hedge book creating.
No, absolutely. And there was lots more in there besides. There was a lot of foreign exchange hedging. There was a lot of other stuff, and that's been one of the big things. I mean, when we started Noah's Rule in 2004, and we wanted to help people kind of manage risk better, and coming on the environment of failure of Pasminco and Sons of Gwalia, we started by saying, look, we don't know what the future is. Future's totally uncertain. But what we can do is we can look back over the last 20 years we've been involved in this market and say, if people who did these things generally got caught out, right? And you do the foreign exchange, you don't do the metal, or you do the metal and you don't do the foreign exchange, or you do complicated derivatives, those people generally got caught out. So let's not do that. So that's been one of our big things with our clients for the last 19 years. Don't hedge the foreign exchange if you're not hedging the metal, or vice versa. Or if you do it, only use options, and that stood our clients in good stead.
Sean, there's heaps of different directions to take it from there. I want to first ask you to give the money miners a bit of scope on what the size of the global hedged market in gold looks like, and sort of compare that with when Noah's Rule started 20 odd years ago.
Yeah, sure. I mean, just around the time, 2000, in the year 2000, roughly around the time the gold price made its low for that 20-year bear market, there was the equivalent of 1 year's annual producer gold production forward sold. So well over 100 million ounces. Today, there's about 6 or 7 million ounces, and about half of that's done by Australian mining companies. So the market was very, very substantial. But you have to remember the price had been falling for 20 years, and the hedge book had been growing. And you had a situation where the lower it got, the more mining companies came under pressure, the more they went to derivative salvation to keep mines open that should have been shut. I mean, there are a lot of boards that just didn't make tough decisions. They wanted I think, what did Rusty call it? The soft issues.
Soft issues.
If you close all your mines, you don't get paid anymore. So if you can hedge them and keep them going, until things get better, and then that's a sort of a bit of a slippery slope. But that hedge book essentially grew every quarter. From 1984, I was around in the gold market in my first year. I think the first hedge I saw get done was in 1985, Southern Goldfields and Southern Cross, the first one done in Australia. Within 2 years, there was a couple of million ounces in Australia that were hedged by sort of Christmas 87, and then it just grew, spread worldwide, and it was over 100 million by 2000, 2001.
Sounds like you described the classic human behavioural bias. We're so pro-cyclical in the way that we invest, instead of being counter-cyclical investors in cyclical industries.
Yeah, well, it gets even worse, because it peaked in 2000, 2001, 110 million ounces. And I used to say to people, if I go away, come back in a year and the gold price is higher, I'm going to ask, when did the central bank stop lending? Because all that gold that was forward sold by those miners and it affected the price was all being borrowed from central banks. If I had figured out that gold mining companies in the next decade would have used shareholders' money to buy that gold back, we wouldn't be having this conversation. I'd be in the south of France with my feet in buckets of champagne, as they say. I mean, you would never have convinced me in 2001 that in 2007 or whatever it was that Newcrest would go to the market and raise $2 billion, buy $5 billion worth of gold in a week and a half to crystallise a $2 billion loss, and use shareholders' money to pay that loss. I mean, you could never have convinced me in 2000, 2001 that it happened. But that happened. And in fact, it happened about 12 times between 2001 and 2012 as all the majors closed out their hedge books. So the hedge book was at its smallest in Q3 2012, when we made the highest quarterly close ever until the last couple of years. Totally counter-cyclical.
To spell that out for the listener, what you're talking about is these gold majors who have deeply out of the money hedge books, closing out those hedge books by doing a giant equity raise. However, they're buying the gold on market. They're a gold miner, they're producing gold, but they're literally just buying gold on market, and they announce the equity raise, use of funds.
To buy gold bars.
Buy gold bars.
And
to close
that
out the hedge
speaks
book.
exactly to what you started the show with, Sean, on the point of dilution. And that's what you really need to compare it with, because to counteract it there, they've just massively diluted their shareholders.
Well, absolutely. And if you think about it, I mean, if you give $2 billion to Newcrest to buy gold bars, right? I mean, there's no prospectivity down dip or a long strike on the gold bar. Like, that's a gold bar they sold some time ago, right? That's a loss. And so they just crystallise a loss. And if anyone who raises money to repay debt anyway, it's a massive discount in equity to begin with, because the people putting the money in don't like it, but they probably feel they have to do it. And so what happened is a lot of people in the world around that time, around 2005, 2008, said if the best thing that companies like Newcrest and all of its peers can do with the cash I give them is buy gold bars they sold sometime back in the latter part of the last century, trying to keep mines open, well, I'm just going to go and buy gold bars as well. And of course, the gold ETF, you can see the volume of the gold ETF increasing through that entire decade as all the punters went, hang on, how many more gold producers now are going to be forced to do the same thing? Because the one thing you guys know from watching this is nobody wants to go too far out on the branch, right? The minute that a few guys buy their hedge book back, everybody else had the strategy, I have to buy my hedge book back too, but they needed to have a share price sufficient to do it. And I had imagined in 2000 that there'd just be a period of time where people would have to deliver in and would have painful years. I didn't imagine they'd still be buying them back when the gold price had gone up fivefold. But that's what happened. And so, yes, totally counter-cyclical. Central banks similarly, right? Central banks were actively selling in the late 90s, early 2000s. Now the saviour of the gold market is the fact that central banks are back in buying it with their ears pinned back. I mean, just people like you and I. I mean, I try to buy low and sell lower. These guys are just, that's generally quite good in the junior sector at the moment. But, these guys were selling low and buying high.
So, Sean, I have to hear you run a business that helps these companies organise their hedge books and so on. How do the conversations that you have with the board of directors at these, mining companies or companies that want to become a miner, maybe then they're in that construction phase, how do those conversations normally go down?
Granted, you just described scenarios where management looks silly for engaging in hedging. So, I mean, there must be some merit to doing it as well.
Yeah. There is. And maybe it's just worth very quickly, just so everyone's on the same page with this. When you do a gold forward sale, all that happens is the bank that does the forward sale borrows somebody else's gold, sells it today at today's spot price, and puts the proceeds of that sale on deposit. So a forward sale for any company is just like a fixed term deposit, right? So you've made a promise to the bank that you're going to produce gold in the future. You've given them all your paperwork, you've given them your models. They've convinced themselves you're going to produce gold and that you're the management team that can deliver. So they go and borrow gold from a central bank or from their clients and they sell it. And so all they're concerned about is you actually being around long enough to produce the gold to give back to them. Because if in the future gold costs more than the money they have on deposit, that money that's waiting to be given to you, then they have to go in the market and buy and they lose money. So gold hedging, people think derivatives and all this stuff, it's incredibly simple, right? So to come into the question, JD, you sitting down with a mining company, you go, well, you want to build your mine. And invariably in the junior sector, and we've had lots of conversations, Catalpa is a really good example when they were Westonia, okay? That's the Edna May mine, now with Ramelius. But, Westonia had an offer from a bank to do hedging. Gold price is about $800 at the time. The bank can let them hedge at $1,100. The price had never been to $1,100. And we're having the conversation with the company and they say, okay, cool. So how much do you need to borrow? Oh, okay, well, it's going to be $70 million to build the plant. It's a few years ago now. Yeah, cool, that's great. But I think the market cap you got is about 12 or 13. That's a bit of a problem, right? And today you can see the same thing. There are companies out there today that would need 120 million, 150, 200 million to build a mine, and they've got a $30 million market cap. the in-ground value of the gold is there. How do you capture that? Well, you're not going to raise equity to do that. So you need debt. So when you're having the conversation with the board and that conversation with Westonia, we said, well, the amount of hedging that you have to do in order to make this financing work, the financing's as good as you'll get. You won't get a better financing. If we were you, we just wouldn't do it. And they said, well, what do you mean? I said, well, it's just too much gold. Like the equity market's going to lose interest because you've sold so much gold in those early years to make it work. Our assessment is that the equity market, well, they said, why would the bank lend us money if it's not a good deal? I go, oh, well, it's a good deal for the bank, and the bank will get its money back for its shareholders. And around that time, we came up with a phrase we used to say to mining companies, you're in the vicinity of being bankable. And that's the most dangerous place to be, right? Because the project's not quite as robust as it might, but between hedging and whatever, you can get it done. And then the brokers are happy because you raise some more money. So our conversations are generally about what are you trying to achieve? What risk profile do you want? And in that case, the board of Westonia quite rightly said, yeah, okay, well, we were kind of thinking it. Let's go back to exploring for a while. That's a really tough decision, right? Because the guy that was the MD had been brought in to build the mine. So he did himself out of a job. He did the right thing by shareholders, right? He left and they went back. And then all of a sudden, of course, the gold price went up, and then we were in the middle of just before the GFC, and the company renamed itself Catalpa. And all of a sudden, they could lock in $1,700 on the forward market instead of $1,100. Costs hadn't gone up. All of a sudden, that just looked easy. And that was a very easy decision. And we sat down with the board and we said, right, same facility, you can lock it in. They went in and locked in, I think it was $1,700 odd. It was the largest hedge that had been done for years. And that project worked. So that was about timing, and that was about just a very good example where the companies just say, well, this is a good idea, but it's too early. And, that's something with equity. They say in equity investing, early and right, is still wrong, in terms of, there's that kind of, it's just, I think, quite frankly, if they'd done it previously and sold at 1,100, it never would have made it through, right? So, the way you're talking to the boards around this is absolutely about trying to balance all the stakeholder needs. And I mentioned those names of those guys before that have been very successful, where they've got significant, equity in those companies, and not necessarily had the kind of dynamics Catalpa had. If you're trying to avoid equity dilution, you've got to take on debt. And I think, in fact, most companies, if you looked at you were talking about Tieto recently, and, they went, that's very rare for a company to go completely equity funded.
Totally.
But they probably got to a point where, as they were going, that debt wasn't available to them, and they had two choices. Do you raise the equity and keep going, or do you go back to drilling? But I think most people will agree that it doesn't make sense from a capital markets or from a balance sheet perspective to build a mine purely with shareholders' equity. So then if you want to get debt, the debt that you can get, the easiest debt you get from the banks essentially require hedging because the banks have no upside. And if the gold price goes down and you don't have hedging, you won't be able to repay them.
We talked about an interesting dynamic. I think it was in our conversation with Alan Trench, and the whole holy grail of investing in resources companies is all about cost curves, right? And it just so turns out that the companies that can endure the volatility of a mining cycle, the lows, are the ones that are, of course, going to be in the lowest cost curve. However, so they're more able to withstand higher gearing. However, if you look at the data, it's actually the highest cost quartile that has the highest gearing, potentially as a function of, you got to just load it with as much debt as possible to build the mine in the first place, because the equity only gets you so far. I keep coming back to that sort of thought as well, that quite often you see the most fragile miners from an operating perspective, also with the most financial leverage as well, which makes them even more fragile.
Yeah. Look, I mean, a lot of old timers will talk about that. Look, we're in the bottom quartile. We don't need to hedge. And that's true. But I think too often mining companies think that a cash balance is a hedge. That because they've got a large amount of cash, they don't need to be too careful about how they manage cash quarter to quarter, because, they can lose money for several quarters and they'll still have a positive cash balance. I mean, my own view is that's lazy, wherever we are in the cost curve. But you're right. I mean, the higher you go up in the cost curve, the more you're probably going to have to gear to get it. And there's never been more money available to mining companies, in my observation, in 40 years than there is today. When the funds started to arrive, is it 10 years ago? I can't remember now, when Taurus first popped up, and then Orion and Red Kites. Actually, it's more than that. It would be closer to 15 years ago. That was the idea. They turned up and said, we'll lend you money and you don't have to hedge. I mean, their whole selling pitch to some extent was, they can't actually provide hedging because they're not a bank. They wouldn't have the balance sheet to be able to do it. But their sales pitch was largely, we're sort of covenant light. We don't need as much things as that. And most importantly, we don't need to hedge. And looking at all the train wrecks and all the buybacks going on in 2000s, you can understand why a lot of CEOs in that period of time said, hedging's clearly bad. I don't want to hedge. If you've been drinking the Sons of Gwalia, Tasmanco Kool-Aid. But the reality was, within that, new mining houses were built and built off the back of doing sensible financing with hedging. And one of the earliest was Perseus. Fantastic success story. Significant amount of hedging on their first transaction. We assisted them negotiate that hedge and that debt, and they've gone on to great things. And they're still a client, and I'm a big fan of what they do. Again, they've created certainty and the capacity to do it. I think in 2013, the year the gold price collapsed, Perseus delivered to the hedging, and they were in an article in a mining press in Canada reported they had the highest realised gold sales price of any mining company in the world that year. I mean, yes, it's a long time ago, but that 1 year, a lot of mining companies didn't make it across the void from 2012 to today.
Sean, there's one other aspect on hedging I want to get into that you touched on earlier, and that's as it relates to foreign exchange. How does that sort of play a role?
Well, I mean, I think the way that we started out on this in 2004 when we started the business was we looked back in the previous period of time, and we had seen people try to decouple their hedging at various times and hedge in, just in US dollars and not to the Australian dollars, or do a lot of Australian dollar hedging and not the gold. But there's a broad correlation. I think everyone agrees, in the end of the day, Aussie's dollar is a commodity currency. The last 2 years have kind of been really, stretching the boundaries of that friendship. But we started, I think the first public presentation I gave at a Pay Dirt Gold Conference in 2005 was gold bulls need to be Aussie bulls, because I was going around Perth at that time and everyone was bullish gold and bearish the Aussie, because I think the Westpac economists were saying, the Aussie's going to go down, China's about finished, 2005. And we were saying, well, you can't cherry pick bullish gold forecasts and bearish Aussie forecasts, because that guy who's bearish the Aussie forecast probably doesn't believe the gold is going higher. But our key thing to our clients was your costs are in $8. You're an $8 reporting entity. The $8 gold price is the price that you need to pay attention to. And people who get too US dollar centric, who run $8 centric businesses, tend to get in trouble, because people go, gold price is going up. In the early 2000s, the US dollar gold price went up 70%, and the $8 gold price was unchanged over that period, because the Aussie dollar was going up as fast as the gold price. So, it's a very dangerous thing, I think, and to not pay attention to. And we've worked with companies now in Brazil, in Canada, in South Africa and Australia. And in all those cases, you have to look at the local currency, you have to look at your cost structure, you have to look at the Canadian dollar gold price or the Brazilian real nickel price, if that's where you're producing, and understand to the extent that you've got costs how you manage that. Now, if you fund in US dollars, in some of those places, that makes more sense than fund in the local currency. Then you take that into account. But overall, you've got to get that right. So an Australian company, it's easier generally to borrow Australian dollars. And most of our clients, when they do a gold mining finance, they hedge in Australian dollars and they borrow Australian dollars. But we have advised, certainly back in the early 2000s, mid-2000s, iron ore company looking to get started in Australia. The banks wanted to lend them $8. And we said, that's crazy. You can't hedge the iron ore price. All your iron ore you sell in US dollars. Why would you increase the $8 operating costs in your business by having $8 debt service as well? Borrow in US dollars. And they reversed that round with the bank, and they did that. So they were trying to balance revenue and costs, revenue and obligations to be as close as possible. I mean, I think it's really, otherwise you're a bit like those farmers back in the 90s and high interest rates in Australia that borrowed Swiss francs to finance their farming equipment because the Swiss franc interest rate was a lot lower. Worked for a few years and then they all got carted out.
I'm really intrigued to understand that dynamic of project finance. For the developer, it's usually a single asset developer.
Yeah.
I can think in recent history for gold companies, what are the gold developers that were able to finance their mine with a project finance facility which incorporated mandatory hedging? Capricorn, Calidus, Red 5,
yep.
The most recent ones that come to mind. WA gold producers now, the three of them. And I think I reckon there are some ways I used to think about how risk is allocated throughout the process that have changed since we first spoke, Sean. And I reckon it'd be handy to kind of unpack what that whole financing process looks like. So just to kind of have it reinforced, when this gold company sort of needs to get into production, they'll look at what they're capable of loading, how much debt they're able to take on, what they think is reasonable, and the bank normally tells them you need some hedging to go along with that. Sometimes you're on the advisory side, and what in that process of development, the company's got to ramp up. It's a pretty damn fragile state for a company. We've spoken about the Lassonde curve plenty of times. It can go horribly wrong. So what does good hedging look like, given that the bank says you need hedging?
Excel spreadsheet, everyone's put everything in, and so you've got all your moving parts in there. You've got 1,000 different assumptions and contributions from engineers and you name it, the different specialties, right? And it's all educated guesses, right, about the future. And the one thing that's absolutely, there's no educated guess on at the end of the day is the price. It's totally uncertain. We don't know what the price is going to be tomorrow, but someone's got to put a line in there. So the bank puts a conservative price in that model, and before there's any hedging in, that price is going to be a lot lower than the prevailing spot price, right? And that makes sense, because if I'm lending you the money and I'm the bank and I don't get any upside if it goes up and I've got all the risk if it goes down because you give me the keys and walk away, I'm going to put a conservative price in. So you put a conservative price in there, and there's one line in the model that's the most important line: cash available for debt service, the CADS line, right? So that's what...
I used to call it CFADs.
Right, okay. So that, CFADs, CADs, it's there. And so that's it. So all the young guys at the bank are doing all the modelling, that's there. And so they go, okay, in theory, if I was to lend you money without any hedging, here's the amount of money that I could lend you, from zero to something, right? And we do that when we do independent debt carrying analysis for potential clients or potential borrowers. Like, one of our big things is you don't ask a bank how much they're willing to lend you. You should know how much you can borrow before you ever go inside the bank. And that's what we try and do for our clients. We give the independent analysis. So we'll give them a table and we'll say, with no hedging, this is the amount of debt we think you could borrow. Now, you might be able to get that from Taurus or Orion, but there's going to be other strings attached to royalties and, and whatever. But at the bank, to stick to that, that's it. Now, if you added 10% hedging, 20% hedging, 30% hedging, this is how the gearing changes. And it's very real, because if you could lock in 3,200 Aussie dollar gold price a couple of years out, including the contango after fees, if you're doing a project financing, and the bank would otherwise put 2,000 or 2,100 in the model for that period, you can imagine that there's a very big difference in the CFADS line between the ounces at 3,200 and the ounces at 2,100. So, the cynic says, oh, well, the bank uses a very low price deck to make it easy to justify hedging. But the middle ground it's there. Now, I'll say to you, in 2004, and I was a bit gun shy when I started Noah's Rule, I'd come through a period where Rothschild had some really dark days in the late 90s. Miners had owed us more than we'd lent them. Some of my colleagues had financed mines that should never have been financed, and they'd helped the company use derivatives to build a mine that should never have been built, right? And we paid the price. I looked at it, I familiarised myself with it, we started to advise clients, and my view then, and is still today, that in most cases the right amount of hedging is half what the bank asks you to do, right? That's my personal view. it should be about half. Now, why do I say that? Because the risk that you take on, to your point of committing, I think Capricorn sold the equivalent of 2 years production, right? 2 years production, I think, was what they announced when they did their initial hedge. So 8-year reserve or whatever. So it's a modest, but it was 2 years. So the idea that you would commit 2 years of gold, 18 months or 2 years from first being able to deliver into that hedge, with all of those moving parts in that model, that's quite a substantial risk, right? And the risk to the bank that when you get there and it's not producing like it would be, and it's public knowledge that that's the case for Calidus and Red 5 of your three.
Yeah.
That's an issue, because if you'd assumed it was 50% of production and now it's 70, that's a lot less freeboard for the company and it's a lot more time to digest. So, I've always had the view. Now, I can have that view, but you can sit across the table from the guys at the bank and they go, yeah, lovely view, Sean, but this is how my model works. And if they want my money, that's the amount of hedging. And, you negotiate very hard. I mean, the interesting thing in that three is that Capricorn hedged far more per dollar of debt than the other two. Certainly, I think Capricorn hedged more than twice as much ounces per $1 million of debt than Red 5 did to get those financings. But very robust business, and it hasn't affected its share price in any way. I mean, it's a very good example of how they were able to keep the capital structure very tight, and hedging worked very well for them. But in my view, when I saw it done, it looked like much more hedging than was needed to support that level of debt, but it hasn't held the company back in any way because they've performed so well.
Mustn't be a client of yours. I'm joking.
No, they're not.
I'm a bit intrigued in a lot of ways, like wrapping your head around as an investor. You don't always think about the hedge book as a liability, and what that sort of means in the context of the fragility of the company. So, you've got you have ramp up issues. Or maybe things are delayed a bit longer. You've already locked in the quantity, the price of the gold that needs to be delivered at that date in time. And the way that kind of materializes in the company is often, if they can't meet it or a greater proportion of their production has to be delivered into the hedge book than total. Sometimes you need equity to top it up, and then you get your dilution.
No, absolutely. Because look, I mean, the problem that you have is, you have the best will in the world of what you're going to do, and then 2 years later you're in production, and you just go to the bank and you say, well, the model's not working quite like I thought, and grade or dilute, whatever it is that hasn't gone right. Combination of all those things can add up to a lot. Fuel prices are higher, costs, whatever, and the bank reruns the model and says, well, yeah, actually now if I, with the hedging in there and with the price I now know and what's going on, yeah, you probably don't have enough cash in the bank. Yes, I need a bigger buffer. I mean, you guys talked about 29 metals the other day. Now they don't have any hedging, but that most recent equity raise, I mean, it wasn't used to repay debt, but that money is certainly there to, in my view, looking at it from the outside, to give their bankers comfort. Mm-hmm. I mean, and it's now part of the bankers' overall risk thing. And in fact, I think Gascoigne, and it's the only time I've ever seen it happen in Australia, I seem to recall Gascoigne did a raise, and no sooner they did the raise than the bankers then closed on them, because they sort of saw the cash as solving the problem, which didn't reflect well on those particular lenders in my view. But that was certainly the case. So if things don't go well, hedging to add to it. But if the mine doesn't perform, the finance team, you can't necessarily go to the finance team and say, oh, you screwed this up. We've done this hedging, we've raised this equity all in good faith that we thought we were going to produce 100,000 ounces a year for 5 years at whatever, and now we're not doing that. But that's, again, my thing, that try and do as little hedging as you can pre-production, because things probably won't go to plan. People are generally all optimistic because everyone's got a show me the incentives and I'll show you the thing, whatever that, expression is of Charlie Munger's. I mean, everyone's got an incentive to do the deal, the broker to raise the money, the bank to lend the money, and it's not their money, it's somebody else's as well. They're just getting a fee. So, everyone's got an incentive to get it done. So when you're in the vicinity of being bankable, all those things come in, and it's just about always trying to have a decent level of conservatism. The other thing, of course, is that we've had a period of time where gold prices and commodity prices generally have just been rising. So it's very easy to be very casual about hedging or to look at companies and say, look at all the money that you've lost. But, my 20 years at Rothschild, I think, God, probably 15 of them, the gold price went down of the 20 years I worked there. And mining houses were still built over that time. Robert de Crespigny built a magnificent mining company over that time. You were still able to make money in a falling price environment, but hedging was far more important to it. Now, I think that's different. But I think I said to you guys the other day, I saw a list of 2 quarters ago when the gold price was very high. I saw a broker put out an announcement of all the money that had been lost by hedging companies, how much cash they didn't make in the quarter. But as I looked across the list of companies, it was very interesting because I thought, those companies have all survived and grown since 2010, 2012. So there was almost like this reverse survivorship bias that you were criticising these companies that had survived a decade and gone on and thrived, whereas their peers that borrowed money and didn't hedge had mostly gone broke somewhere in that period. And certainly most of their North American peers, that was the case because they're atrocious over there in the way they approach their financing, in my observation generally.
Sean, you touched on a broker report there, announcing all the lost potential revenue. I'm keen to hear from you if you think there is a bit of a lack of disclosure. Like, we notice it all the time. We noticed it today researching for the show. It can be pretty hard to find out what the actual hedge book is when, at certain quarters, how many ounces have to be delivered. Do you think there is a lack of disclosure by mining companies on the exact nature of their hedge book?
Yeah, definitely. I think it's changed over the years. I know it's different from company to company. My recollection is, back in the day, people laid out full tables of where they were and each individual year and what. And some still do that. So you've got an idea of how many ounces they're obliged in those different years. I think some companies that want to try and maintain a bit more flexibility, some of the companies in the past that might have done that might have been less so. But at the end of the day, I think the most important thing to really understand is the total number of ounces and the prices at which it's committed, and certainly getting a handle and be able to track for analysts the negative mark to market is a good check back to that point about John McDonald and Sons of Gwalia. The mark to market was actually the thing that gave the smart people early on the understanding that what Sons of Gwalia said it had and what it had were different, right? So, but yeah, I think generally you could be. I think it's interesting. Perseus, in their most recent quarterly, they talk about their profitability. They talk about the hedging. You have to look quite hard to actually see how many ounces that they produced, because they're all about making money. They're in the business of making money. Mining's how they do it, and that's the way they present it. So, it is different for different companies.
I got a bit of a gripe. We spoke about companies using hedging to get project finance, and they often have a bit of an announcement, project finance facility secured, looks like this. So sometimes the hedging comes later, sometimes it comes at the same time.
Yep.
And the broker reports, which we just spoke about, quite often you read them and people just look at the coupon rate of the debt and assume that's the cost of debt for the company. But clever people, mate, realise that's not actually the cost of debt. You got to factor in some other things too. So from the purview of a hedge guy, how do you figure out the real cost of debt for a company?
Well, if there's hedging involved, you're not going to know what the real cost of debt is until you get to the end and it's fully repaid, and you can look at all those other numbers and how much the hedging and everything costs you, right? In the same way, if you look at the coupon on a Taurus deal or an Orion deal, and then you have to wait till you see what the royalty that you gave cost and all the rest, right? So there's a much broader impact. I think the more important thing in many cases is, I come back to that. How much dilution did you need to get it done? Because if the financing goes well, then the most important thing is going to be how tight you kept your capital structure. But then coming more directly to your question, there's no doubt that some CEOs really love to tell the market they got a low margin over, because that implies how creditworthy their company is. And that's a bit like the magician's dancing girl. right? That's the obstruction, while over here, you've got the other thing. And there's, I have met mining companies that had no idea what margin was on their hedging. They didn't even know what discount to the wholesale price the bank was charging them. So they didn't know what the upfront cost of their hedging was. They didn't know if the hedging was twice as much as was actually needed to justify the financing or not. Those costs can be, very substantial. And if the hedging margin, let's say the hedging margin is 1/3, the margin charge for hedging is 1/3 of the margin charge for debt, but the face value of the hedging is multiples of the debt, that's a very substantial additional cost to the company. Now, if the price goes down, there's no cost to the hedging. I mean, the hedging is a positive contributor, right? But in terms of the cost and the margin on the hedging, I don't think that the margin they charge on the hedging is the most significant part. I think it's the extra year of hedging that the bank does in order to make the model really robust that wasn't needed. Because if you think about in the 2000s, the really tragic stories like Taranga, I'm trying to think in a few others that, you do your financing, you do the hedging, you lock in the hedging. The bank also gets to sweep all the surplus funds, right? So you've got an amortized schedule you have to repay, and then anything over a certain level you have to give them as well. The gold price went up dramatically. Lots of those companies repaid their debt within 18 months of being in production. But they had hedging that was still going out 3 and 4 years. And 4 years later, the gold price had doubled and trebled again. And though that last year of the hedging that probably never should have been done in the first place, that's where the enormous cost to these financings is.
There's a few things I'd love to have the opportunity to relate to some real world experiences on companies that we come across pretty often. I'm keen to talk about Regis, right? Because Regis has got this real reputation for having the worst hedge book. It's had that reputation for as long as I've had a professional career in finance.
How long ago did you get into finance?
Start of 2020. Regis's reputation, it was just, I think gold ripped, and all of a sudden, everyone's just clued on to how bad Regis's hedge book is.
Yeah. Some of us had clued on a little bit before then. But
I'm sure you were. I wasn't working before then in finance, so I couldn't have. But I can read the history. It's not as bad now. So it's currently 120,000 ounces, but it's at Aussie $1,571 per ounce, and it's they've reduced it oversized by delivering into it, but it's the price that really catches your eye. You're like, how can you possibly have a hedge price that's almost half of spot price right now? It's baffling to think of how that possibly could have come about. But I'd love you to walk us through the mechanics of how you end up with a hedge at that price.
Well, it's actually incredibly simple. And if you think back to the example I gave of that fixed term deposit, right, that's all it is. That the idea that, you've got the bank's got your money, your sales proceeds, and you don't get it till you give them the gold. So when you turn up, and let's say the gold price is $1,400, your hedge is $1,400 and the gold price is $1,600. If you go to the bank, look, I'd really rather sell the gold at $1,600 than delivering the hedge at $1,400. Do you think that's possible? They go, yeah, no worries. That's possible. How far did you want to roll the obligation out? Let's roll it out a year. So they just take your money that's on deposit and they roll it out for a year. But before they roll it out, like it's a fixed term deposit, they say, yeah, but you owe me $200 now because the gold price today is $1,600 and your contract's only worth $1,400. So I'm going to lend you that $200 an ounce, and this is the interest rate I'm going to charge. Sometimes they tell them, sometimes they don't. They calculate the interest rate they're going to charge on that $200 embedded loss. They then go and look at the forward price. They impact all that in, and they go, okay, your 1,400 hedge is now 1,430 1 year out, and you get to sell at 1,600. Everyone's happy, right? That's fine. But we have said to our clients from day one that the minute you do a hedge to a date to meet an obligation to underwrite debt, or particularly if it's mandatory hedging, but you sell at a price you're comfortable to deliver into to meet your objectives and to avoid that early dilution. The minute that you say, please, sir or ma'am, can I roll that hedging forward when it's out of the money, you've got to treat it like debt. at least partial. It's like a gold-denominated debt. So Regis's strategy was very simple, and it's a strategy, those guys grew up in the market in the 90s, right? And Samantha and whatever the companies were in their earliest days with Nick Georgetta. In a falling price environment with high contango, everybody did that. And that made perfect sense. We turned up in 2004 and we said to all of our clients, everything that you learnt in the 80s and 90s is no good anymore, because we're now in a low contango environment and we're in a rising gold price environment. And until that stops, you should never roll out of the money hedges further forward. It's bad thing. So what we call, our clients, we say hedgeable hygiene. You should always deliver into your hedges on time, and you should try and accelerate. Regis was the anti of that, right? They still were dealing with the 90s. So they would, every time they had a higher price spot, they would sell spot and they would roll their hedges forward. And they were very open about that. In fact, I've heard them talk about that. I mean, and they never underperformed the gold price for a decade. They always sold spot, and if the price was lower, they delivered into hedges. But the problem with doing that was, as that loss got bigger, the unrealised loss, although it was unrealised, it wasn't uncharged. They were essentially earning no contango. So I just happened to anticipate that you might ask me this question, Travis. So I've dug back into the archives, and back in 2012, Regis had a hedge book of 188,000 ounces, and the present value of that hedge was 1480. Okay. In December 16, they had a 404,000 ounce hedge, and the present value was about 1546. Right. So, and today they've got 120,000 ounces, and we'd estimate the present value is about 1542. So, in 7 years, the price hasn't changed. In 7 years of contango. Now, by comparison, Northern Star in 2014, their hedges were at 1429, and today they're at 2,645. That's the PV price. And Ramelius back in March 2015, like 1582, slightly better than Regis has today. Today, the hedge book's at 2670, let's say. That won't be the prices they're declaring to the future, but that's our estimate of the present value, right? If you closed out today, what's the spot equivalent, right? So those two companies have gone from 1,400, 1,500, like Regis had back then, to 2,600, 2,700, because they've always delivered into the hedges when they matured, and sometimes they put new hedges on. So they deferred the benefit of those new hedges. Regis kept on rolling the old hedges and taking the cash during that period. So their cash performance then and their dividend payouts and everything was fantastic. But you might, if you're familiar with Oscar Wilde, The Portrait of Dorian Gray, they paid the price. They were the handsome young man, on the surface. But meanwhile, they've just got this bigger and bigger gold-denominated debt that's growing in the background. And, the brokers were very kind to them for a very long period of time. No one really ever mentioned it. And I've been approached at diggers, in places like that, because people say, what do you think about, 10 years ago, people would ask, what do you think about Regis's hedge book? And I go, well, it's going to work really well if the gold price goes down, and it's going to work out really badly if the price goes up, and you guys all think the price is going up. So the strategy doesn't make sense to me, but it made sense for a very long time from a cash perspective and a capacity to pay dividends and all those things.
But you can maintain a wonderful price to cash flow multiple, but you kick the can down the road.
Yeah. And that's, I think, to your point about reporting, like people have to pay more emphasis to the negative mark to market of the hedge, because essentially I've seen companies say we're debt free, and so, well, you're debt free, but you've got this hedge that's out of the money. That's a gold denominated debt, because it's getting bigger. The potential cost is getting greater. And the further in future you go, the costs are going to go up. The one thing you can be certain about is the cost of producing gold is going to increase over time. So why would you want in 10 years to deliver into today's price? I mean, at least you want the benefit. We never recommend our clients hedge more than about 18 months to 3 years forward and on a tapering basis, right? And that's, the longest hedge books in Australia, I think now are probably like 3 years, right? The idea you would carry the same hedges on your book for a decade, it never made sense to me.
It's an interesting phenomenon, because if you keep, rolling your hedges forward, then in the future, you've still got this pretty substantial production commitment. And I think about Regis, in the context of their acquisition of Tropicana, which also happened in 2020, by the way. I remember when that transaction was announced, they acquired Tropicana. Consensus was they paid too much for it, but it gave them access to a larger production profile, which in our last conversation you pointed out to me actually would have assisted in delivering their hedge book.
Would have made their bankers a lot more comfortable about the percentage of the debt. Let's go back and just you talked about Sons of Gwalia before and the pit wall failure. I mean, I will be absolutely happy to say to you that Sons of Gwalia, their strategy in their last days, like trying to acquire ounces, some of the deals they did, I have absolutely no doubt they did that to increase their production profile, to try and diminish their hedge obligation. I think that was very obvious, and that's sort of easy one to talk about because they're not around anymore. Shouldn't talk ill of the dead, but yes. Anyone who's got a large hedge book and as it becomes an increasing percentage of your reserve resource position, you're going to become concerned about that, and sometimes the tail starts wagging the dog. In rising price environments, it's amazing how often clients want you to update what's a negative mark-to-market position. They don't keep revaluing the in-ground inventory that's not hedged. People start to be concerned about that because it's an obligation.
And it's you said a sentence there that the bankers definitely would have been more comfortable with it. And I think this is a point that gets lost with a lot of people, myself included, to be honest. And that's that, like, we often think of the bank's downside in the context of, the project finance facility that exists, and think that the bank's downside is sort of capped to the quantum of that facility. We could talk about Calidus, if we wanted to. You mentioned that it's public knowledge that they've had some ramp-up challenges. The model's probably not matching, right? And you look at what's outstanding there, it's like $81 million to Macquarie. And, in my simplistic mind, I used to look at that and think, the downside to Macquarie, if Calidus, worst case scenario, goes tits up, it's capped at $81 million downside to Macquarie. But it's not, because of the hedge book. Can you tease out that dynamic of why the bank's sort of exposed worse than just the quantum of the facility?
Absolutely. And I sort of touched on it earlier in my experience when I was in the banking. I mean, one of those common misconceptions is that banks take the other side of the trade, right? People think, all the upside, the bank's made all that. No, as I said, they've borrowed. I mean, when you do a project financing, you borrow money and you get the money, and you borrow gold and you don't get the money. The money gets put on deposit, and that's the forward sale. So if you think about it like that, you have two obligations. The bank has two liabilities from the company. They've got the cash liability and they've got the gold liability. And that gold liability is only limited by the gold price going up. Now, in a log normally distributed world where there's a 50-50 chance of the gold price going up or the gold price going down, when they run their risk profile, they go, that's really good. If the gold price goes down, under any circumstance, they can still repay the debt. That's why they're comfortable to let the company hedge, right? If the gold price goes up and the mine fails, you have to go back in the market and buy that gold, like we talked about with all those companies that they didn't fail, but the hedge book got so big they just raised equity. Companies like Newcrest and all the others back, and Barrick back in 2000. So the bank, one's on balance sheet, one's off balance sheet, but that exposure's there. So the negative mark to market. And I have the very unfortunate position having turned up to quite a few creditors meetings in the late 90s. As the lender, right, as the secured lender, and when a company dies, I mean, it's, companies in a death spiral. They do some terrible things in terms of just the greengrocer and the newsagent. No one gets paid, right? And the mine's still producing gold, so everyone at the mine says, "Oh, mate, we poured heaps of gold. It's good. We're good for it." And all these poor little people turn up, and we're owed. They said, "But you lent them $40 million. Why are you claiming 80?" Well, because we had to go and buy the gold back in the market, and that cost us another 40. Now, we're stupid. I'd like to shoot the lending officer that ever did the deal in the first place, but our shareholder, the Rothschild family, lost twice as much as they lent because that gold-denominated liability had increased. The gold price had gone up and the mine failed. So that's a dynamic that's there. And the equity market's aware of that in terms of what happens to the share prices of these companies that have it, because people clearly understand, the sophisticated people understand what the liquidation value is, right? So, but, nobody borrows and does hedging that doesn't expect to be able to produce, and the bank has scrutinised the model. So when it doesn't go to plan, it's the rarity, but it happens, right? I mean, it happens. But I think the good thing in Australia is the banks work very hard with the mining companies to try and restructure and roll those hedges out and do whatever they can to let them get through. And that's an important part. When we are helping someone borrow from the bank, the caliber of that bank and their capacity to deal with problems is one of the most important criteria. There are some banks we just say to our clients, well, I just wouldn't borrow from them, because the minute things get tight, there'll be some new guy comes from the workout team and, that's it, it's lights out, right? That's you don't want that. You want them to say, how do we work through this to get out of this together? How do we, if we can, let's mine our way out of the problem.
I think that's an important takeaway that I have is Calidus is another example, right? The hedge book is also with Macquarie, and the debt's with Macquarie. And I imagine in my simplistic brain that if you're having issues, that the fact that the two are with the same counterparty, there's going to be greater flexibility to negotiate, a change in your repayment structure, for example, because Macquarie's aligned on the downside from the hedge.
Very much in their interest for it to work out.
Yeah, so Calidus is a client of ours. We've been helping them on the hedging side. We weren't involved with helping to negotiate the debt. Somebody else did that. But we certainly were involved in overseeing the execution, making sure they got the right pricing on the day and all that type of thing, which is part of our service. But so just to be very open, but they your perspective is absolutely clear. There is nobody that has more of an incentive to ensure that Calidus can keep on mining and meet its obligations than the bank, because you don't want to have to go in the market and buy gold. If the gold's in the ground, you figure out and work with the company to find a way to get through. And there are several examples where I've seen companies in a similar position to Calidus where they've gone on, they've dealt with that situation and survived and continued to prosper. And it's just about it just becomes a bit of a digestive issue, when your model is not what you expected, right? I mean, nobody planned to be in the position that they're in. That's just the position that they find themselves in, and that's mining. And again, that comes back to my point about I always just work on the basis of whatever you think in the model works, try and do it for half as much, because then you'll have a little bit more freeboard. If you do get into that situation and prices are different, you're not quite so tight.
It's been a wicked conversation.
Yeah, fascinating.
Sean.
Really appreciate it, Sean.
Yeah, but before we round off, I've just got to ask about the optics of someone who spent 20 years working at Rothschild having an Occupy Wall Street poster behind you. What's the? And
I've realised the entire time that I've had a black swan sticking out the top of my head too. But, yes, it's funny. We've had quite a lot of query about that recently. We had a big office. There was lots of blank, and I wanted lots of art on the wall, and that's literally my brother took that out of a magazine and we blew it up and painted it on canvas. But I just like the Monopoly Man, the kind of Monopoly Man image of the Saddam Hussein thing. It resonated me as a very clever piece of art, and I am kind of a bit contrarian by nature. I have my own business because after 20 years of working for a private company, I considered I was unemployable in a normal kind of institutional type framework. So anyway, but it's sort of a bit like our name Noah's Rule. It's a bit of that picture's a bit of a conversation starter. So yes, but the black swan there underneath that, if you can see, there's a cartoon which was in the AFR, and it's a black swan typing on the keyboard, and he's typing, "Dear editor, please cease and desist in using my name inappropriately." And we just love that because so many people talk about being destroyed by black swan events that are something that's the same thing that happened 3 years ago, right?
That's hilarious.
It's become a very, very convenient thing for people. Like, who knew black swan? Anyway.
Love it, and really appreciate your time, Sean. I'm sure the money miners have taken plenty and learnt heaps about hedging, just like I have really along the way today.
You and I are both unemployable, Sean. I swear too much publicly these days.
Well, can I just say, look, I really, as I said the other day, I love listening to your podcast is very fresh. I like the fact that people are being held to account. People are going to be a bit more cautious about how they present things in their presentations if they know that somebody's actually reading all the detail and is going to call them out on things. And, it's great to have a bit of an independent voice. I mean, too many people are kind of sponsored by the same very people they're chatting to. So keep it up.
Well, you're welcome to sponsor us, mate. We'll probably accept it.
Love it.
Very good.
Cheers, Sean. Thank you.
Cheers,
Sean.
guys. Thanks. Bye-bye.
There you goes, guys. What do you reckon, Matty?
Oh, mate. Well, I wasn't there, so I don't have too much opinion, but I do look very forward to listening to the whole thing.
Yeah, it was great. A lot of value to be sort of
Historic
taken.
lessons and like some very contemporary case studies there, which just help to understand the present a bit better by learning about the past, and he sort of tied that in wonderfully. Love a bit of Sons of Gwalia talk as well.
I can say hedge. I can talk about hedging now, can't we? The episode's finished. It's not a mystery anymore.
It's not a mystery, mate.
We're not holding on to everyone any longer. Yes, that is. I'd like to. Maybe we could do. We're talking about doing series. Mining niche series, like if you're going to look at really niche industries that people are absolute experts on, hedging would be one of them. I'd be interested to see what other ones we can come up with and find experts in that field.
Absolutely, mate. And this one, it's niche, but it is almost everywhere in Australia. It's pretty common. And like he said, not just in gold anymore, you do see it in other commodities. And I think we'll see it sort of, I wonder if we'll see more of it in emerging commodities as well.
Well, even after speaking to him in the office before he did the episode, just probably the misunderstanding of what hedging is throughout the market from the probably more people like myself that aren't entrenched in the finance world. But did you guys from the finance world even think, wow, shitloads I didn't even know about hedging?
Exactly, mate. Definitely.
Yeah, well, that's always good to hear.
Awesome, guys. Couple sponsors to thank.
Oh, we've got a couple, all right. JP Search at the top of the show. We've also got Anytime Exploration, K-Drill, SMEC, Power and Technology, and
Terra Capital.
How could we ever forget our great friends at Terra Capital?
Love it. Cheers, guys.
Hooroo.
Thanks, Money Miners.
Hooroo.
Hedge your bets.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.